Dr. Lal PathLabs is now in focus. The stock has gained about 30% in the calendar year so far. The company says there are no plans to take any price hikes in FY25. Revenue growth is expected to be above 10%. To talk about the business outlook and the way forward, we have Shashank Banerjee, CEO of Dr. Lal PathLabs, joining in. Mr. Banerjee, good to have you on. Thanks for being with us. First things first, want to talk about business for sure, but now this whole monkeypox threat, we keep hearing about this as well and the new guidelines that are kicking in. First and foremost, is there anything that you're noticing? And I don't know if the testing is right now open to a lot of the private labs like Dr. Lal. Just tell us the latest on this.
Yeah, good morning. I think, yes, monkeypox is something which is in the news of late, and, everybody has their eyes on it. As of now, testing is restricted to government institutions only. And I think as and when, and I think the government has said also quite clearly that right now there isn't enough cases, etc., to really worry about it. But I'm sure that, if there is something like that, they would open up to private diagnostic companies later. But that is completely dependent upon how the government looks at that. So as of now, we are also watching it on the news and keeping a track of it.
Sure, fair enough. So yeah, let's just hope the situation remains under control. Having said that, let's get back to business and what you've outlined so far for the year. This idea of about 10% growth. Tell us what is driving the business as of now, which segments, and also why only 10%? Now that we're almost done with the second quarter, do you get the confidence that growth levels could be better than this?
So, we had put a bit of context on growth for FY25 specifically. I think FY24, we ended the year at about 10.4% growth. And a part of that growth was also, driven through a price increase that we had taken in February of the year before. So close to about 3.5% of that 10.4% actually came through a price increase. So what we have stated, for the year FY25 is we want to do slightly better than what we did, 10.4%, but without having to take a price increase. And that's what, we are all working on. And that is kind of, giving the confidence back into the system that the kind of underlying business growth can become robust. So that is really what we are trying to work on. I think what we also saw last year was that there was this whole overhang of COVID and non-COVID tests related to COVID. So there was quite a lot of base fluctuations that we have seen. So I think we really need to see a few stable quarters and one maybe financial year before we can start looking at maybe future projections beyond that level.
Okay. Mr. Banerjee, hi, good morning. Prashant here.
Good morning. Good morning, Prashant.
So, we spoke with you exactly a month ago, and at that point you said that you do better than 11% without a price increase. So we look forward to that, and maybe once this quarter is done and you've reported numbers, you'll up the guidance in that sense. Could you tell us how's Swasthfit been doing? Because that's been the big driver, bundle testing. It forms about 24% of your top line. Just give us a sense of whether momentum is strong there. What else are you doing in terms of product initiatives?
I think first things first, what we have been saying consistently is that for FY25, we will do better than what we did last year. And obviously, the target would be to see whether the financial year we can do 11%. I think that's what we would be targeting internally without having to take a price increase. So I think that's, and we were talking about the full year because, quarter on quarter, there could be variations, multiple reasons why variations happen. I think our business is best to look at the full year performance and, the growth numbers, etc., on a full year basis. So that's what we have said, and we continue to talk about that itself. That better than last year in terms of growth. Last year we did 10.4. not without having to take a price increase. I think that's what we are all aiming for. Coming to Swasthfit, last financial year, Swasthfit was about 22% of our overall revenue portfolio. First quarter, we did about 25% of the portfolio revenue was the Swasthfit. So we continue to see momentum on Swasthfit, and given that we are increasing our reach further into tier 3, tier 4 towns and other geographies also, we have still got a lot of confidence that we'll be able to keep growing the Swasthfit portfolio at least for the next near future that we see.
Right. On that 11% growth guidance itself, assuming you do not take a price hike, I wanted your thoughts on how to read the volume versus realization growth here. Because on the one hand, your realizations would be propped up by some of your specialized tests. And on the other, there would be some of the offers, as you said, you're penetrating into newer areas, etc. as well, that may pressurize your realizations. So this 11% growth for this year, X of any price hikes, how should one look at in terms of volume and realizations?
So again, I think, let me reiterate, we are saying growth better than last year. Last year was 10.4, so the number starts from 10.5.
Okay.
Yeah, but we'll obviously be targeting somewhere around 11 if we can get that. And this is again a full year picture. So coming back to the growth mix, there are certain factors which are helping us getting a better mix. So first and foremost is Swasthfit itself. That is a higher realization, and therefore it is accretive to improving the mix. Second is specialized tests, like you pointed out, that is another part of the business. As it grows, it helps us on the revenue per patient side and a better mix. Plus, we are also seeing some benefits likely to accrue through some better geography mix, which we are also working on.
So what does that do to your margins? Because, last year you did closer to around 27, 28% margins. What's the guidance for this year?
So the guidance for this year is, margins similar to last year. And that's what we are, even last year, if you see the margins, there was a bit of a flow through because of the price increase that was taken. But we want to really look at maintaining our last year margin level. And that is without having to take any price increases as we intend for this financial year.
So to sum it up, Mr. Banerjee, just sort of a bigger picture question, and I take your point that, we need to have normalization of a couple of quarters, leave COVID behind, to get a very clear understanding of the growth rate the business can operate at. So while 10 to 11% might be the numbers we're looking at this year, I mean, what's the aspiration? Your margin profile at 27, 28%, probably investors will have no complaints there. But what will be the aspiration on growth? And in that context, what is going to be the rollout plan, the expansion plan in the West? I don't know if South is a big market you'd look at, because you already have a dominating position in the North.
Yeah, so we have a kind of, geography-wise, slightly different strategies. So North and East, which is our, core markets, there we are going quite deep in terms of our expansion. I think we've been talking about, going into tier 3, tier 4 kind of markets, and that is predominantly in North and East. And those are, that kind of is helping a bit in terms of, our presence as well as our ability to reach a much higher number, of people. And it's a very populous geographies like, UP, Bihar, etc., where we are really going deep. So I think that's one part of it. West, we have done, Suburban acquisition. It's almost about, 2 years plus there. And that is the brand and on the platform on which we are riding. West is now contributing close to about 15% of the overall revenue. It's become quite sizable for us. And, the focus on that brand and that geography is going to be through maintaining the two brand strategy and a lot of focus on Suburban. South is also, an area we are now looking at, where we are, we stated this earlier, is we are open to looking at organic as well as inorganic play for South. because South currently contributes, single digits about, to our overall revenue, and we would definitely want to improve there. So
Found
given
anything
this whole,
interesting? Sir, for the South, have you found anything interesting, and what's your appetite? What is the right size target that you would consider? And I mean, what's the thought process? Since you're clear on inorganic growth in the South, will you be using internal cash, size, and timelines?
so there isn't anything really definitive on the table right now which one can share. But we are obviously looking at opportunities, and we are really not looking at a size profile as the key driver. I think it is more important on how and where we can get access,
Got it.
and obviously the quality of the asset, as well as the valuations, etc. That so this is an ongoing process.
Right.
I think whenever we have something interesting to share, we will share that.
All right, Mr. Banerjee, we'll leave it there. Thank you very much for your time. Appreciate it. And thanks again for joining us.